Imagine buying a stock and waiting 34 years just to get your money back. Not 34 days. Not 34 months. 34 years. That's exactly what happened to an entire nation of investors. And most people have never heard the full story. I've watched a lot of bubbles inflate and burst over 50 years. But nothing compares to what happened in Japan. At its peak, this was the most valuable stock market on earth. Bigger than America's. People believed Japan had figured out something the rest of us hadn't. They were wrong. And the third mistake they made is the one investors still repeat today. Right, this time is different. By the late 1980s, Japan looked unstoppable. Its economy was booming, its companies were buying up trophy assets around the world, and money was flooding into stocks and real estate. On December 29, 1989, the Nikkei 225 hit its all-time high, nearly 39,000 points. Now here's the part that still sounds insane. Land prices got so extreme that the grounds of the Imperial Palace in Tokyo were said to be worth more than all the real estate in the entire state of California. One palace versus a whole American state. That's not a market. That's a fantasy. Draw, cheap money arrow to buy land, arrow to prices rise, arrow to borrow more, a loop. And when everyone believes the fantasy at once, the price of everything detaches from reality. Which brings us to the how. Here's the number that should have been a warning. Japanese stocks were trading at price-to-earnings ratios of around 60 times earnings. Think about what that means. At 60 times earnings, you're paying 60 years of a company's profits to own it today. The math only works if growth never, ever slows. Right, price is what you pay. Value is what you get. That's Buffett's line, and it's the whole lesson in one sentence. Price had run miles ahead of value. But the crowd wasn't looking at value. They were looking at the price going up, and assuming it always would. Sound familiar? This is Mr. Market at his most manic. And Mr. Market always sends a bill. In 1989, the Bank of Japan finally hit the brakes. Under new Governor Yasushi Mino, they raised interest rates sharply to cool the mania. Draw, BOJ raises rates, arrow to borrowing stops, arrow to bubble pops. Cheap money was the fuel. Take it away, and the fire goes out. Fast. The Nikkei didn't just dip. It collapsed. By 2003, it had fallen to around 7,600. That's roughly an 80% decline from the peak. Land prices cratered too, dragging banks down with them. The 1990s became known as Japan's lost decade. Then it became the lost decades, plural. And here's the fact that stops people cold. The Nikkei did not reclaim its 1989 high until February 22, 2024. 34 years. A baby born the day that market peaked was middle-aged before it recovered. Now compare that to the American investor who kept buying through crashes and just held on. This is why the price you pay matters more than almost anything. Buy a great asset at an insane price, and time stops being your friend. Right, overpay, and time turns against you. The margin of safety isn't a nice-to-have. In Japan, its absence cost a generation. Here's what I want you to remember. A bubble isn't caused by bad companies. Japan had brilliant companies, Toyota, Sony, real-world beaters. The bubble was caused by great companies bought at impossible prices. Value investing doesn't just ask, is this a good business? It asks, and what am I paying for it? Right, the price you pay decides your return. Get the price wrong, and even the best business in the world can leave you waiting decades. That's the whole game. So let me ask you this. Do you think we're seeing bubble behavior in any market today? Tell me where in the comments, I read them. And if this changed how you think about the price you pay, hit subscribe. This is educational content, not financial advice, so always do your own research. Tomorrow, we're looking at an investor who saw a crash coming and made a fortune from it.